Thanks everyone for coming. I was thinking about this just the other day that in some ways this might be one of the more important, presentations you could sit through if you're not already incorporated. This could be tremendous tax savings. It might not be. It might be. It's definitely good to explore. I incorporated myself 4 or 5 years ago, and it made sense for me to do that. I'm an S corp, and I'm not a broker, but I'm kind of paid similarly to brokers. So it made sense for me, and it saves me, like on average, I think it's like around 8 to 10 grand a year in actual net dollar for my situation. Obviously, everyone's situation is different. So I was thinking, like, the only reason I knew about it is that I had somebody come in years and years ago and talk to me. So I thought this would maybe be helpful. So this is Timmy from BMK. Which is a CPA firm. They're accountants. They do a lot of different things. I knew his boss or the owner of BMK, Brian Kim, and Brian's a super great guy. He's not my accountant, but not for any reason that I already had somebody before I met Brian, and they haven't screwed up enough yet for me to switch, although I may be switching soon. Anyway, so I know that Brian does a great job. There have been Kale brokers that have gone to Brian and worked with Brian and probably other team members, so nobody's ever complained. I've only heard good things. So anyway, Timmy was nice enough to come in and talk about, we talk about like S corps, maybe LLC. Okay, so he'll explain some of the potential tax benefits for that. If you haven't done it, it's great because like the way I've got mine set up is I'm a corporation, or I have a corporation, and I'm an employee of my own corporation, and I pay myself not as much as my company earns. So I only pay income tax on the amount that I pay myself, but because I'm the business owner, I had access to all of the funds. So, and then it's not quite that simple, but that's the basic idea. So he'll talk more about that, and you guys can figure out if it makes sense. But anyway, thanks again for Timmy. I'll turn it over and enjoy. Thanks, Timmy. Take care.
All right. So if at any point in the presentation, if you cannot hear me, just please raise your hand and just let me know. I know it's running in the background, so it may be a little hard to hear the whole presentation. So my presentation today is going to be on S corporations, why you would want to form an S corporation, and then the biggest takeaway that I'd like you guys to have is how you can minimize your taxes by forming an S corporation. So regarding the biggest takeaway, it's really regarding Social Security and Medicare taxes. It's also known as self-employment taxes or FICA taxes. As sole proprietors or LLC, single member LLC owners, you would be subject to paying taxes with Social Security and Medicare. Social Security is 6.2%, and it's taxed up to $118,500 of your earned income. Once you exceed $118,500 of earned income, you're no longer subject to Social Security taxes. $118,500. So anything above that threshold, you're not subject to 6.2% for Social Security taxes.
So you said LLCs are subject to that?
Right. So single member LLCs and sole proprietors are subject to both Social Security and Medicare taxes. Now, with Medicare is taxed at 1.45%, and it does not get cut off like Social Security does for any thresholds. So regardless of whether you make $50,000 or $500,000, you'll still be subject to Medicare taxes. Now, when discussing self-employment taxes, there's two sides to the puzzle. There's the employee side and the employer side. So on the employee side, the combination of 6.2 plus 1.45 comes out to 7.65, and then the same percentage applies to the employer side. So when you're talking about self-employment taxes, you're really talking about 15.3% for Social Security and Medicare on both the employee and employer sides. Now, who pays Social Security and Medicare taxes? Now, if you're a regular employee of a business, you don't have your own business, you work for somebody else, Social Security and Medicare taxes are taken out on your weekly paychecks or however often you get paid. It's taken out of the paycheck, so you don't have to worry about submitting any of those taxes. It's reflected on the W-2 that you get at the end of the year. So you're only responsible for the employee portion. If you're a W-2 employee, the company that hires you is required to pay the employer portion. So they pay the 7.65, you pay your 7.65 for the combination of the 15.3%. Now, for most of you, you probably fall into the second category of independent contractors or sole proprietors. So in the past, when you've done your taxes, you probably filled it out on Schedule C of your personal tax return, and all of your income is subject to the 15.3%. So that gets reflected on page 1 of your personal tax return, but essentially because you're your own business, you're both the employer and the employee, so you're subject to 15.3%. One way that you can avoid this 15.3% is to form an S corporation. With an S corporation, you pay $0 of self-employment taxes. The percentage is 0, but there's a catch. And that catch is you have to pay yourself a reasonable salary. And the IRS's ruling for S corporations is that they must pay the S corporation owner a reasonable salary if the owner provides services for the corporation. And when it comes to reasonable salary, it's really dependent on what the going rate for a particular profession is. I mean, it depends on which location you're located to. So if you're in Chicago, New York, LA, the reasonable salary would be much higher than if it's in a smaller city. But as long as you pay yourself a reasonable salary, you could get away with creating an S corporation and not paying Social Security and Medicare taxes on the remaining portion. If there isn't a going rate for a particular profession, we recommend that you stay within the 30 to 50% range. If you want to be absolutely safe, I would say do a 50-50 split between 50% of the profits going as salary and 50% of the profits going as business income. And the purpose for this rule is because salary is considered W-2, and W-2 is always subject to self-employment taxes. And as an S corporation, you getting paid through a W-2 will satisfy the employee portion, and then the S corporation will cover the employer portion to max out at the 15.3% self-employment taxes. Next, this is just a brief general example of how the S Corp strategy would come into play. So the stick figure represents an owner of an S corporation. So throughout the year, if the S corporation earned $100,000 of income and the stick figure paid themselves a reasonable salary of $40,000, that $40,000 would be subject to the 15.3% self-employment taxes. The remainder would just flow through as business profits and would not be subject to the 15.3%. So in this particular situation, the stick figure is saving themselves $9,180 by not paying self-employment taxes on the $60,000 of business income. And I mean, this is just a general figure, but reasonable salary, like I said, is really dependent on what type of industry you're in, what profession you're in. But for example purposes, this still falls within the 30 to 50% range. So you could definitely get away with paying yourself $40,000 salary on $100,000 profits brought in by the S corporation. To go a little bit more on the classification of the income, the salary portion that was classified as $40,000, like I said, is subject to the self-employment taxes. It's also subject to federal and state taxes as well. The business income, it's not subject to self-employment taxes, but it's important to take into consideration that it is still subject to federal and state taxes. So the only thing, the biggest area that you would be saving on would be the self-employment taxes. But regardless of whether 100% is salary, 100% is business income, or it's a mixture of both, you're still subject to federal and state taxes. There's no way around it. There's only the way to get around the self-employment, Social Security and Medicare. So this next slide is just a brief estimated savings that you would see based on net incomes brought in throughout the year, starting from $40,000 up to $150,000. Please note that this is These figures are based on you paying yourself a $40,000 salary. So if you look at the top line, 150,000. So 40,000 of 150 would be salary, and then 110 would be business profits. So you can obviously see the higher that you bring in as far as income, the more you'll save. Typically, we tell our clients that if you're in the $80,000 to $100,000 range, that's when it really makes sense to really consider becoming an S corporation. If you're under the $80,000 range, it may not make too much sense, because even if you're bringing in $60,000, you see their savings of $3,060. It kind of does get offset by the additional costs of creating the S corporation, which I'll go into on the next slide. But if you're under $80,000, it's really up to you, but you truly won't see a benefit. If you're in the 80 to 100,000, most likely you'll be in six figures pretty soon, so it makes sense to start considering the S corporation route. But if you're over 100,000, it definitely makes sense, because bringing in 150, you're already seeing savings of about $17,000. So far we've discussed why it would make sense to become an S corporation. So now I'll go over some of the reasons that people would not become S corporations. So as a sole proprietor or a single member LLC, you reflect all of the tax activity on the Schedule C portion of your personal tax return. There aren't any additional business tax returns or forms that you would have to fill out. But with an S corporation, you have to fill out a separate business tax return, which is due on March 15, a month prior to your personal taxes are due. In addition to filing a separate business tax return, there are additional taxes associated with S corporations. On the federal level, there aren't any taxes, but on the state level, there are. For Illinois, it's a 1.5% tax on the business profits brought in for the year. So it's really dependent on the state level, but for Illinois, it's 1.5%. On the federal level, there is never any taxes, regardless of where you're operating out of. In addition to filing a separate return, filing additional taxes, you're going to have to report your salary on a quarterly basis to the IRS and to the states in the form of quarterly reports. You're also going to have to deposit your taxes on a monthly or quarterly basis, depending on what type of structure you set up for your payroll. And what I mean by depositing your taxes, it's the federal taxes, state taxes, Social Security, Medicare, and federal and state unemployment taxes. So there's various taxes associated with forming an S corporation, but depending on the payroll system that you use, they do a pretty good job of reminding you so that you're not late on those payments. There's also additional accounting, reporting, and fees associated. Accounting primarily with the way of bookkeeping. It's really important. I mean, you probably all already do a pretty good job bookkeeping for your business as it is, but with S corporations, it's even more important just because of the additional tax return that you have to file. So bookkeeping is of the utmost importance. And fees. So when it comes to fees, there's really no structured figure as far as how much the tax return would cost. But from our experience, if you have an S corporation, you should expect to pay between $800 to $1,000 for the preparation of the business tax return itself. So that would not include the personal tax return. That's just strictly with the S corporation business tax return.
And that's not per quarter, but
Right,
annually?
right, absolutely. Just like filing your personal tax returns. So the fees, and then on top of that, you have to take into consideration the fees for starting the S corporation, Secretary of State fees, payroll setup. So, I mean, when you consider all of those factors, you're probably looking at anywhere from $2,500 to $3,000 as far as just the fees for the S corporation itself. Which is why in that previous slide I said if you're under the $80,000 to $100,000 income range, it really wouldn't make sense because these fees will offset the savings that you have for income below the $80,000. And quickly, just the biggest difference between the LLCs, the single member LLC, sole proprietorship, and the S corporation really does come down to the savings on self-employment taxes. So currently, right now, the way you guys are structured, if nobody's an S corporation, you're paying 15.3% on 100% of the business profits that you guys bring in for the year, after you factor in the deductions that you have for the LLC and such. But with the S corporation, the salary portion is what is subject to the 15.3%. The remainder is not subject to it, but is still subject to the federal and state taxes. So, I mean, if you're over $100,000 in income brought in for the year, then in my estimation, it really would make sense to become an S corporation. But then again, if you think that the income's going to fluctuate where you'll bring in 150 this year, but next year may be a bad year where you bring in say $80,000, you may lose money next year or get close to pretty close to break even. So it's really dependent on looking towards the future as far as how your income structure is going to be coming in for future years when considering whether the S corporation is the best route for you